welcome to the Thematic Climate Panel. I'm biased as the moderator, but I think this is one of the most interesting panels of the day, not only because it represents really interesting investment opportunities that are cash flow positive and very interesting right now, but it solves a lot of acute societal issues that are really coming up in today's world. To my mind, it's really the nexus between the most compelling investment opportunities and those societal problems. And on this panel, we've gathered some of the most impressive thematic investors from around the world, in my opinion, that really are experts in terms of the intersection of investments, water investment, sustainable infrastructure, and renewable energy. So those are the themes we'll be kind of diving into today on the panel. And these themes are not only extremely relevant today because of the economic cycle that we're in, where investors are looking for insulation from market volatility. If you've been following the news today, even the Fed hiked interest rates again, and the 10-year yield is above 4% for the first time since 2007, which just feels pretty ominous to a lot of us. And a lot of these strategies do very well and don't correlate very highly with traditional indices and benchmarks. But we're also in a global energy crisis, exasperated by the Ukraine war. We have an infrastructure crisis. Case in point, there's entire cities in the US right now without safe drinking water. Jackson, Mississippi has been mentioned a couple of times today. It's a city of 150,000 people that don't have access to safe drinking water for the last couple of months and likely won't for the foreseeable future. And the types of investment strategies we'll talk about on this panel don't only check the investment return box, but they help solve those societal issues that I've been talking about already. So I'm your moderator for the day, Adam Bernstein. I run the ESG and climate research for Gitterman Asset Management. And we have an esteemed panel of investors that are all part of our investment products. They're part of specifically our Climate UMA suite, which we distribute to other advisory firms, bank trusts, and endowments and pensions. And without further ado, I'll let them introduce themselves, their companies, and their themes to you.
So I'm David Sher, and I'm one of the founders of Greenbacker Renewable Energy Company. I love coming to the New York Stock Exchange because for the first 25 years of my career, I moved electronic dots from one screen to another. And then I saw the light, and I co-founded Greenbacker in 2011 with a partner. And really the goal was to create a fund that would allow ordinary investors to participate in what we saw was going to be a renewable energy revolution. And what we do is we make direct investments in solar farms, wind farms, energy efficiency projects, et cetera, throughout North America. Right now, I think we have over 400 individual solar and wind assets. It's over $2.2 billion of direct investments. And these are essentially little power plants that generate electricity and sell electricity to utilities, municipalities, and corporations. So we've been at the forefront of sort of creating the new asset class around renewables. And we see an incredible future opportunity to grow this into a much larger segment of the market.
Thanks. My name is Padraig Sheehy. I not only have the funny name, but I have the funny accent. So please bear with me. I'm from Dublin in Ireland, and we like to talk. So in that context, I work for KBI Global Investors. We're a boutique asset manager with about 14 billion in assets under management. About 6 billion of that is in our natural resources strategies of water, clean energy, sustainable infrastructure, and our recent addition, circular economy, which is all based about reuse, reduce, and recycle. We are part of a larger group called Amundi, which some of you may or may not know. They are the largest asset manager in Europe, but we are a significant player in their active management business. They have assets under management of over 2 trillion. We are long-term signatories to UNPRI, dating back to 2007. We're very strongly committed in the impact in ESG space. We have the top ratings within UNPRI across all the 3 areas of focus, including this year, where they have changed to a 5-star rating. And I'm glad to say that we have achieved that. On a personal note, why I may be new to New York and new to the stock exchange, being my first visit. My grandparents emigrated here back in the 1940s after World War II. They lived in the Bronx. I came in the summers and I worked here. I grouted Marble and Battery Park just a block or 2 over. So I think they would be very proud here to have their grandson. So it's a great honor to be able to speak to you today.
Great. Thanks. Matt Desario. I'm the co-founder of Water Asset Management. We started Water Asset Management in 2005 on the core belief that scarce, clean, reliable water is the resource defining the 21st century, much like oil was the resource that defined the previous century. We manage both public listed equities globally that invest in companies around the world that ensure water quality and water supply. So everything from regulated water and wastewater utilities, companies that are involved in long-term concessions around water and desalinization, companies that manufacture all different kinds of water-related products and provide services, water-related technologies. And we have a separate team and a separate business that invests in private equity in regenerative farmland and water resources and water rights here in the United States. The water industry is one of the great industries to invest in for long-term capital appreciation. The reason is that provides an essential resource. It does so through business models that are either regulated monopolies or oligopolies for the most part. And what's important about those 2 business models is the ability to price, to get pricing. And the water industry is one of the great industries for long-term, very gradual, but sustainable, inflation-protected pricing power. And what that does is it translates into an industry that is much less correlated to most of the macroeconomic factors and concerns that people here at the New York Stock Exchange have been trading around for the last couple hundred years. So there's not a lot of correlation with the growth of the water industry as it compares with broader industries. The reason climate change is bad, the reason we're here, we're talking about capital and climate, and people are spending a lot of time thinking about climate change and the implications. It's 2 words. It's drought and flood, and then I would add intensification. The primary negative implications of climate change are on the hydrological cycle, the intensification of drought and flood. Almost everything else that we all talk about as it relates to climate change and what's bad about it are 2nd and 3rd derivatives of the intensification of drought and flood, whether it's food security, whether it's biodiversity loss, population migrations, conflict. I mean, if you think about it. And the companies in the water industry that we and others here in the room invest in, most of them have been around for decades. They grow their earnings and their dividends by addressing, and have been doing so for decades, the problems around drought and flood, and water supply reliability and water quality reliability. So, climate change it's a tailwind for the water industry. And one of the points that you'll hear me make today is that what we need from people in this room is a greater, and by the way, Jeff's been very active at driving this, but I'll just underscore it, is a greater awareness and recognition of the importance of adaptation to climate change and investing in not only increasing people's mind share and awareness around the importance of adaptation, but also the capital commitment around adaptation. Most of what people talk about around climate change, as we all know, is mitigation. It's renewable energy, which is obviously super important, carbon sequestration, electric vehicles, All very important stuff, but that's all focused on mitigating carbon and hopefully reducing temperature increase in the future, and some of it in the very distant future. We need equal emphasis, balance, and capital allocation around climate adaptation. Dealing with the world we have now that we've created, like it or not, that's water. Investing in companies that ensure water quality and water supply is the forefront of climate adaptation. And the last point I'll make is that one of the other great things about water is that there's no ambiguity around the positive impact that investing in these companies delivers. I mean, we believe that every one of the companies in our portfolio and all of the private equity activity that we do, and happy to kind of delve into it, all these companies grow their earnings by making the world better. If you believe ensuring water quality and water supply and making it reliable is a good thing, and we do, that's positive impact. And because water is so measurable, it's easy to measure water. It's harder to measure some other things that we're all focused on around climate. But that provides very clear, simple, definable, measurable metrics that you can put in one column right next to the market-beating returns that you get from investing in the water industry. And maybe with that, I'll pass it back.
Thank you so much. Thank you for the introductions, everybody. So I thought we'd kick it off, and Jeff said it when he introduced the panel earlier. We were making a move from public equities, ESG investing in the last panel, to thematics. And I wanted to make sure we differentiate this panel from some of the public backlash and political backlash that ESG investing, specifically equity investing, has been garnering in recent months and years. A vast majority of that criticism has been really focused on the data providers, the MSCIs, the Sustainalytics of the world, and the ETFs and indices that use their ESG scores. In recent months, even political debates have turned negative on ESG, with governors and state pensions divesting from managers who punish oil and gas companies who have poor climate and emissions policies. So the question is open to everyone on the panel. Can you describe for us why these critiques don't apply to your thematic investing?
Well, maybe I'll just start by saying that, obviously there's a lot of ways of slicing ESG, and obviously there's environmental, social governance. One of the advantages of what we're doing is we focus on E. I mean, there are other elements to our strategy. We are trying to do other things, but it's crystal clear that when we make an investment in a renewable energy power facility, that it's going to mitigate the amount of carbon that would otherwise be emitted into the environment. We mentioned water at the beginning. Renewable energy saves a tremendous amount of water over, let's say, coal. I think if you were to produce the same amount of energy we have since 2016, using coal, it would have been over 3 billion gallons of water wasted. So it has an element of that sort of mitigation. So I would say it's focused on a measurable quality, namely we're producing electricity that is less carbon intensive than other forms of power, and that is measurable. The other thing that is clearly measurable is job creation. When we build a new solar farm, we're going to employ thousands of people to build it, or hundreds of people to build different things. And we also have ongoing maintenance service providers that are there for the long term. One of the fastest growing job segments in the United States is wind turbine technician or solar technician. So there's a lot of opportunity for young people to get jobs in a rapidly growing industry. So I think there's some elements to that. And I would also say that in spite of the way that it's portrayed in the media as some kind of blue-red divide, in fact, the red states generate a lot of opportunity for renewables. You look at the Midwest, there's tremendous amounts of wind there. There's tremendous renewable energy construction in Texas, for example. So it is something that I think when you get below the surface is something that people do agree on. There's two things I would say people agree on in the United States. One is that they hate Congress. I think it's like 8% favorability. And the other is they love solar energy. I think 90-something% of people like solar energy. So there's a lot of what I would say general good feeling about the industry, and it's measurable in the carbon mitigation side.
Yeah, thanks, Dave. Maybe just to add to that from an external viewpoint, we would say that the data providers are easy targets. You know, going back to Matt's point, you need to be able to measure, you need to be able to understand, you need to be able to quantify what each of your companies are actually doing. The problem in my eyes is with the industry itself and how it has adapted those scores. You know, they've taken an easy option, you know, effectively many providers just taking the best performing ESG score, basically using it as a screening device in terms of being able to put ESG product effectively on their platform. And what you've ended up with is an unintended bias, you know, overweight growth type stocks, overweight tech in particular. That was great for the last number of years. You're paying the price for that now in that context. And that was at the expense of the fossil fuel sector. And again, you know, we're not advocates against fossil fuel. It's a transitionary process. You know, it's a marathon rather than a sprint. If you're looking at targets of carbon neutral by 2050, we believe engaging within those companies, you know, set boundaries, set rules, set expectations of the management, and use that as a benchmark effectively to understand how that company is managing that and meeting those targets. And if not, then take action, I would say, in that context. In our portfolios, we use ESG as an input, just like we would in any other valuation metric in terms of investing. And in comparing like-for-like companies, looking at earnings growth just like anybody else, because ultimately what we're trying to create is an alpha proposition. And I think that's reflected in a time where impact and ESG investing has struggled as a general sense in the last 12 to 18 months. I look across each of our strategies over that time period, and we're performing exceptionally strongly against that. And that's reflection of the more balanced nature, using ESG as an input, but also reflecting the fact that these companies have higher earnings growth, typically growing by 2 to 3 times higher than what the market is in general, and that's reflected in the share price.
Thank you. And going back to David for this next question, we're in the midst of a global energy crisis. On one hand, we don't have enough supply to meet demand. And on the other hand, access to reliable energy has become a national security issue, with countries shoring up their energy supply chains with the goal of becoming self-sufficient. Can you describe for us the role renewable energy plays as one of those solutions?
Well, so renewable energy is unique in that it does not require a feedstock. So you don't have to import some feedstock that you're going to burn in order to create renewable energy. The sun shines everywhere. The wind blows in certain areas, and in particular, the United States has a huge amount of wind resource. It's a little more sporadic than, say, solar, but these are things where you don't require that feedstock in order to generate electricity. So when you build renewables, you can build them local to the load, where, let's say, you have a data center that's using a lot of electricity. You can build a solar farm nearby, generate the power, and you can sell that power there. So to the extent that you use renewables, you get some of that benefit. The main issue that you have with renewables is the intermittent nature of the power, right? It's not, the sun is not always shining, the wind isn't always blowing. So there is a growing need for storage of some kind, and there are many different modalities of that that are out in the market, where ultimately you'll have some kind of mix of the renewable capturing the power and then holding it in storage in some way so that it can be fed out at different times of the market cycle. So I would say the great thing about renewables is, even though it is difficult to permit anything in this country, literally anything, it is easier to permit a solar farm than it is a combined cycle natural gas power plant, and certainly easier to permit than a nuclear power plant. So there's elements of all of the kind of soft costs associated with the energy that make it so attractive. It is a low-cost source of power. Both solar and wind are very low cost. They're relatively inert, although all energy sources have some externalities. They're just nowhere near the externalities associated with other traditional power sources. So overall, I would say it's a combination of those things. That said, planning ahead for a crisis like Ukraine, and we should have been many years spending more on renewables, right? We should have been ahead of the curve. We sort of just allowed things to sort of evolve naturally, even though we see this gigantic climate crisis coming. We haven't done as much as we could have. So I would say now there's a wake-up call. I think in the short term there will be a painful winter in Europe, but I think over time people will start building more kind of infrastructure to insource or keep onshore energy, and renewables are all by definition onshore.
Thank you, David. And staying with you for a minute, are there any particular renewable technologies, since you're really boots on the ground and you see a lot of these come through your door, that excite you in terms of energy production capacity, carbon abatements, and economics?
Yeah. So I would say that the great thing about renewables is it's, let's say solar has arrived as a technology. It is easy to manufacture, relatively speaking. It's broadly available. There's going to be more manufacturing in the US. There's a lot of things that make it a particularly good form of power generation. Wind is also an area where there's been tremendous efficiencies, and so that's definitely well on the way. The issue that you have with these two types of power is they're not great at generating heat. And you need heat in order to have industrial processes of certain kinds. So we think that green hydrogen is going to be a big area of growth in the market. That is hydrogen that is produced using renewable energy to split water into its component elements. We think it will be a big area. There is a tremendous amount of investment in the manufacturing of electrolyzers. That costs are going down on a similar curve to some of the other electronic devices. So I would say that's going to be an area where we're looking at a lot of growth.
Got it. And Podridge, given the fact that you and your firm are based in Europe, could you elaborate on the energy crisis, the problems as you see them, and how your portfolio would address those solutions?
Yeah, it's a very difficult environment, and as David has alluded to, we are facing a very difficult winter this year. It has woken up in lots of ways the over-reliance on 20th century fuel resource, effectively. So it's accelerated the conversations around that topic. But there are big implications, both from a company level, from a consumer level perspective. You're already seeing that happening on the ground. There's probably a 20% fall off in the demand for gas over the summer months throughout Europe, which is significant in itself. One of the key risks I was going to highlight in advance of this has actually been taken out overnight, which is a big distributor in Germany, in particular, Uniper, which has been nationalized by the German government in that context. And that was a systemic risk in the sense that it was the major distributor throughout Europe, and if it failed, it was a whole systems failure, effectively. But that comes at a price. You've seen it in terms of the costs. The German government had already put 20 billion towards it. It's now had to privatize it. You see it in terms of the UK, where they have put price caps on something that they don't own. So they've effectively written a blank check at an overall level, and will probably cost hundreds of billions. And in that context, at a time where inflation is already a difficulty, energy is a major part of that, interest rates are rising within Europe. We can ill afford for them to rise given the state of the European economy. The likelihood is that you're facing a recession. I do think we'll get through this winter. We've had time. The German have gas supplies up to about 90%. Nord Stream, if that ever gets back up and running, even only by 5-10%, would be a game changer, even for this winter. The real worry, I think, is into 2023 and into 2024, because you will most likely go in with very low reserves across the board and across the economies. And that's going to impact petrochemical companies, industrials in particular, all of those which are facing shortages. They're already looking, governments, independent governments, and one of the difficulties in Europe is that you have 28 countries all trying to vote on the same thing. But they're, at a consumer level, they're going to restrict the supply or charge excessive rates during 5 and 7 o'clock in the evening, basically to try and limit use. So there are practical implications. The flip side of that is, I live in Ireland. We get rain 300 days a year, and there's a mass demand for solar panels in that context. So the growth in that has been enormous. Likewise, in terms of electric vehicles, again, people are moving, and it's that emphasis, effectively, that has happened because of the need. But it does all pale into insignificance as you walk around the streets of Dublin or anywhere else, and you see the Ukrainian refugees and their families and their kids, effectively, and what's happened from that perspective. In terms of our own strategies, yes, it is helpful at an overall level. It has accelerated the pace of growth. We don't see it as a major enhancement in terms of the earnings for the companies this year. They're probably net neutral, and that's probably twofold. One is that a lot of them have hedged already in advance, but that will be offset by the windfall tax that's expected to be agreed by the end of this month by the EU, which will effectively put I think a 33%, as is proposed today, tax on excess profits above 20% over the average of the last three years. That's very manageable by the companies that we're invested in, and longer term, this is a huge tailwind to drive this industry forward.
And Prodridge, would you mind just elaborating a little bit on what types of assets the sustainable infrastructure strategy would invest in? Just describing the different asset bases that you look at.
Yeah, there would be quite a mixture of asset types within that. You're talking utilities, obviously, are the obvious ones, solar providers, solar infrastructure plays, anything that has to do with data or with energy storage, in particular, would be some of the significant plays. Transportation in terms of efficiency from that perspective. So all of those play into what we would call a very diverse portfolio that's globally diverse, both geographically and from a revenue stream, and providing strong stability with strong dividend growth of about 3.5%, what we target every year for the portfolio, along with, as I say, good liquid opportunities, which typically helps when you compare it to the private side of the business. We're not one against the other, but we certainly believe we're a strong complement in that space.
Great, and I'd love to jump now from the energy crisis to some of the large legislative victories that have happened around the world with the IRA bill, the bipartisan infrastructure bill, and the EU Green Deal, to name a few. These will act as a tailwind for thematic portfolios for years to come. Can you give us a breakdown on some of the key provisions and how they benefit your portfolios? And again, this is open to all the speakers.
Sure. Well, do you want to start? Go ahead.
Sure. I mean, the Inflation Reduction Act that some people are referring to as the Inflation Enhancement Act is actually quite positive for the water industry in the U.S. One of the particular elements is a $4 billion, I don't know if you guys remember when Senator Sinema held out, one of the things she held out for was a $4 billion line item to actually pay farmers to conserve water in the Southwest and then have access to that water to basically store behind the dams at Lake Mead and Lake Powell. And that's something that's in our private equity activity, that's something that we've been doing for years. We get paid by the federal government to fallow certain farms, conserve water, and then we leave that water in the Colorado River system to elevate the water levels in Lake Mead, which you've probably seen pictures of. I mean, it's a very serious problem. One that has a very simple and actually not that expensive solution. So that's an example of something that's kind of microcosmic that was, for us, we were very happy to see. There's also scores of billions of dollars allocated to improving water-related infrastructure, which obviously benefits not only the consumers and ratepayers, primarily in municipally managed water and wastewater systems, but also the companies that we invest in that provide those goods and services and pumps, pipes, meters, et cetera, that go into ensuring those systems, provide reliable supply.
So for us, it's a game-changing piece of legislation. It's firstly the largest energy-related bill that's ever passed in my lifetime, probably. And it will make major changes in the way people look at renewables. It gives you a 10-year certainty around tax credits for production tax credit as well as the investment tax credit. For solar, you can now choose between investment and production tax credit, so that gives you the ability to look at different geographies and adopt certain other kinds of things. There's a provision about transferability of the investment tax credit, which might, based on what the rules come out, be a huge game changer. And also there are new credits for new technologies such as battery storage for the first time, standalone storage. There's, for green hydrogen, there are tax credits associated with that. So I would say overall it's provided this kind of long-term certainty. And in the short term, really what it has done is it changed the dimensions of the way firms like mine look at the world. Because every year for the past couple of years, you've waited till the end of the year to see whether Congress was going to do something about the tax credits or whether they were going to keep them or not keep them, and it was always waiting till the end of the year, and everyone struggled to get a bunch of deals done in December, just because they wanted to either safe harbor panels or do things like that were all based on getting a higher tax credit. So Christmas in the renewable energy business was terrible. And now it's going to be good because you don't have to worry about that anymore. You have 10 years of certainty around the dimensions of the tax policy. And so it's just going to mean that there will be more kind of smooth movement in it. And I frankly think it's going to result in multiples of the installed base in the United States for renewables.
Yeah, I'd have to agree with everything that David said. It's a historic piece of legislation. Having worked and decided the business for over 20 years, I think one of the biggest criticisms we would have been around government support, in terms of it. And it's very real. It's very tangible. Is it perfect? No. Are there going to be issues with it? Yes. But it's a major step in the right direction.
Great. And now that we've tackled the energy crisis, sustainable infrastructure to a degree, I'd love to focus on water, the asset class of water, right? It's one of my personal favorite asset classes to invest in, and it's one of the most lucrative over the past 10 years to invest in. So Matt, could you outline a little bit more? You spoke on it when we first started a little bit, but can you elaborate on the investment thesis for water and how your strategies are helping us fix our water issues as a society today?
Sure, yeah. I mean, again, just to maybe repeat a little bit, but water is obviously an essential resource. It's extremely capital intensive, and it had been taken for granted and underinvested in literally not just for years or decades, but for generations. A couple of different things have happened so that ignoring water is no longer the case. I mean, when we started, there was no news stories ever about water. And we've been, leading in the development of water as an investable asset class. And so we've done a lot of missionary work explaining the economics to, different kinds of allocators and policy people and stuff like that. And now people are realizing that every portfolio should have an allocation to water the same way portfolios have an allocation to healthcare, technology, whatever, real estate, energy, whatever. And that's happening. That's definitely starting to happen. Along with that capital intensity, it's an industry that is not really very well understood by a lot of people, and including a lot of sophisticated investors and allocators. And that gives somebody who's focused on it, exclusively as we are, the opportunity to develop a domain expertise. And then ultimately, the goal in investing is to have some kind of an information advantage, which we've been able to develop over the last almost 20 years. It's an industry that is not only it's a huge global industry, obviously, but it's all local. So it's almost like real estate. Real estate's a big industry, but the real estate market in Hong Kong is different from that in San Francisco. Water's the same way. It's very much of a localized industry, albeit a very large industry globally, and it's also operationally segmented. So we like to say there is no water industry per se, because a water utility is a very different business model than a company that manufactures a new kind of membrane for desalinization. And that operational segmentation, along with the geographic segmentation, creates an inherent portfolio risk mitigation. So there's no way you're going to come in, I call it the Bloomberg top story risk, that you don't come in one day and say the top story is, plenty of cheap, available water everywhere it's needed on Earth. I mean, we're not going to ever have that. So there's no single event or story or macro kind of factor that can put the kibosh on the whole industry for a period of time. And that inherent mitigation is also offset by this growing capital investment, we call it a super cycle, of spending, that it has to happen. I mean, we all collectively as people around the world, whether you're a government, agriculture, industry, or consumer, we have to spend more in order to ensure water quality and water supply. The crisis situation around water quality and water supply, it's much worse than you read about, because governments lie about water. They're disingenuous about water and water supply in terms of its reliability and its availability. And that said, every water problem on Earth is solvable. There's not a water problem that we've ever encountered or seen, whether it's massive or small, that's not solvable. It requires capital, water industry competence, and the will to act. And if you have those three things, it basically kind of boils down to more pipes, pumps, meters, and management. And we often get the question, I may be running on here a little bit, but I'll just finish with this. Good. That we often get the question around technology. Is there a great new water technology that's going to be, the Google of water and solve all the problems? There are a lot of very interesting new technologies being developed around analytics, media, data management, et cetera. But the most important technology in the water industry is actually regulation. The right regulation that includes ultimately tariff setting that covers all of the operating and capital costs to provide water. That's how you get reliable water 24/7 days, 365 days a week. And that's what drives not only conservation, but the implementation of innovative technologies and behavior. So there's plenty of examples all over the world, and sometimes in places that you'd least suspect it, where the regulation has been written in a way that is non-political, it's iterative, it's transparent, it's fair. It includes that full cost pricing. It's done in a way that everybody on the upper and lower end of the socioeconomic scale can get access to water in a way that is affordable. Anyway, it works. So that's
perfect. Well, thank you all so much. That's our thematic panel today, and I hope you guys got a pretty good understanding of why thematics as a sustainable investor are so important. And as someone who builds ESG and climate portfolios, you really have to have these kind of securities in your portfolio. If you're a wealth manager, if you're an asset manager, to stay relevant from a risk return perspective and a marketable perspective, you really have to be, you have to access these themes today. So thank you guys so much. Appreciate your time.
Thank you.
Thank you, Adam.